Now let's go over the cost-volume-profit relationship. So what is the cost-volume-profit relationship? The first thing we need to understand is the cost-volume-profit analysis. And it's a management tool used to examine the relationships among selling prices, sales and production volume, cost, expenses, and profits, and all of this is useful for managerial decision making. So ways cost volume profit analysis may be used include things like analyzing the effect of changes in selling prices on profit, or the changes in cost on profit, or changes in volume on profit. It also helps us in setting selling prices, selecting the mix of products to sell, or it could be also helpful for choosing among different marketing strategies. So we'll see different examples for how all of these kind of analyses can be used. And let's first understand the topic or a term called contribution margin. So what is a contribution margin? Contribution margin is the excess of sales over variable cost. So when we make extra over, or extra, I don't want to use the word profit, but like contribution that would help us generate profit and cover our fixed cost. We call that contribution margin. So the contribution margin is basically the difference between the sales and the variable cost. And here we're talking about total sales minus total variable cost. And if you think about it, the sales minus variable cost is the extra amount that's available to cover our fixed cost and our profits. So we call that the contribution margin. So contribution margin is the amount of revenue that is available for covering fixed cost and earning a profit. So let's see an example. Assume the following data for a company called Lambert. So we have sales of 50,000 units, we have sales price per unit of $20 per unit, we have the variable cost per unit of $12, and we have a fixed cost of $300,000. So if we try to create a quick income statement, we can start with the sales, which is 50,000 units multiplied by the selling price, which is $20, that would be $1 million. Then we subtract the variable cost, which is the same 50,000 units multiplied by our variable cost, which is 12, or variable cost per unit, which is $12, and that would be $600,000. The difference between these is the contribution margin, and it's equal to $400,000. You can think about it as 50,000 units multiplied by the contribution margin per unit, which is $8, which is the difference between the selling price and the variable cost per unit. So that's $8 multiplied by 500,000, and that's $400,000. Then if we look at the fixed cost here is 300,000, so the remaining balance, or the remainder here, is operating income of $100,000. So that's how this is presented, and we can see like how the contribution margin helped us to cover our fixed cost and our operating income. So the total of these two values is the $400,000. One thing we also need to understand if we're talking about contribution margin is the contribution margin ratio. Contribution margin can also be expressed as a percentage, and that's what we call the ratio. So sometimes we refer to it as the profit volume ratio, which indicates the percentage of each sales dollar available to cover fixed costs and to provide operating income. So how we calculate the ratio? The contribution margin ratio is the contribution margin divided by sales. So if we go back to our example for Lambert Incorporated, our contribution margin was 400,000. If I go back to the previous slide here, 400,000 divided by 1 million sales, that would be 40%. So the contribution margin for this company is 40%. The ratio is also useful in developing business strategies, and we'll see other examples. So in Exhibit 8, which what we had before, Lambert Incorporated earned $100,000 of operating income on sales of $1 million. If I go back here, that was Exhibit 8. We had $1 million sales. We're able to have an operating income of $100,000. Assume that Lambert Incorporated increases its sales by $80,000, which is selling additional 4,000 units at the selling price of $20. So now our total sales would go up from $1 million to $1,080,000 for the sales of 54,000 units. The operating income would increase from 100,000 to 132. It increased by 32,000. So how we got this number? Just let's do the math. The sales 54,000 multiplied by $20. That's $1,080,000. The variable cost, the same thing, 54,000 multiplied by 12. That's 648. The difference is the contribution margin, 432,000. So we can calculate the change in operating income to get the 32,000 using this formula here. So the change is equal to the change in the dollar value sales multiplied by the contribution margin ratio. So our sales went up by 80,000, multiplied by 40%, and that's 32,000. And that's how the contribution margin went up from 400,000 to 432. Notice the operating income also increased by 32. So the unit contribution margin is computed as follows. We get the sales price per unit minus the variable cost per unit. And I think the unit contribution margin is also a good variable to consider. So we've been talking about contribution margin in total so far in the previous example. Now let's try to think about it per unit. And I think I gave you like the flavor of this when we were going over Exhibit 8 here, when I told you, look at the contribution margin as 50,000 multiplied by $8 per unit. So that's the contribution margin per unit. Or maybe you can call it the unit contribution margin. So the unit contribution margin, again, it's the selling price minus the variable costs. So go back to our Lambert Incorporated example. The selling price was 20, the variable cost per unit was 12, so the unit contribution margin is $8. And that's how we calculate it. When a change in sales volume is measured in units, the unit contribution margin can be used to compute the related change in operating income. So in other words, when the change in sales goes up by $15,000, the unit contribution margin will multiply by the unit contribution margin to get the change in operating income. So we got the 15,000 multiplied by 8, and that would be 120,000. So in the previous exhibit, the previous example for Lambert Incorporated, they had an operating income of $100,000 when they had 50,000 units of sales. So selling an additional 15,000 units increased Lambert Incorporated operating income by 120,000 from the 100 originally, so that would give us 220. So let's see the calculation here one more time. So the sales 65,000 multiplied by 20, that's 1.3 million. The variable cost, again, the same number of units, 65,000 multiplied by 12, that's 780. Notice the contribution margin now went up to $520,000. So 65,000 units multiplied by the unit contribution margin of 8, that's 520,000. So if we subtract the fixed cost, which is the 300,000, the operating income would be 220. So going back to here, so the $15,000 increase in sales multiplied by the $8. By the way, the dollar sign here should be removed. Just 15,000 units sales increase multiplied by the $8 per unit. That's 120,000. That's the amount of the change in operating income that we noticed here. It went up from 100 to 120. So now let's talk about the mathematical approach to cost volume profit analysis. The mathematical approach to cost volume profit analysis uses equations to determine the following: the sales necessary to break even, as well as the sales necessary to make a target or desired profit. So I want to know what is my break-even point and what is my, not just the break-even, not just also making a desired profit. What would be the sales necessary to reach that point? What we call it the target or desired profit. So the break-even point is the level of operation at which a company's revenues and expenses are equal. In other words, you have no profit, no loss. Of course, that's not the best situation because any business is there for profit, But at least you want to see, like, what is the minimum amount of sales that I need to make in order to be out of this deal with no loss. So the break-even point in sales units is computed as follows. It's the fixed cost divided by the unit contribution margin. So we can think about the break-even point as the point where our revenues would be equal to our costs. Assume the following data for Baker Corporation. We have fixed cost of $90,000, we have the unit selling price of $25, the variable cost $15, and our unit contribution margin to be $10. So the break-even point for Baker would be $9,000. How we calculate it? We get the fixed cost divided by the unit contribution margin. Our fixed cost is $90,000 divided by $10, and that would be 9,000 units. So when we make sales for 9,000 units, we should have an operating income that's equal 0, where our revenue would be equal our cost. So let's see this example here. The sales, 9,000 multiplied by 25, that's 225. The variable cost, the same 9,000 multiplied by 15, which is our variable cost, that's 135. Subtract the 135 from the 225, that would give us a contribution margin of 90,000. If we subtract the fixed cost of 90,000, which was given to us, the operating income would be 0. And that's our break-even point, which is 9,000 units of sales. So, if we look again at the Baker's income statement, the break-even point is $225,000 in sales, which is calculated based on 9,000 units multiplied by $25 of sales. And the break-even point in sales dollars can also be determined directly using a very similar model. We get the fixed cost divided by the contribution margin ratio. So we get the unit's contribution margin divided by the unit selling price, and that we get the ratio. So 10 divided by 25, that's 40%. And then to get the break-even sales in dollars, we get the fixed cost divided by the ratio. So it's 90,000 divided by 40%, and that's $225,000. So that's another way of doing it. Again, if you look at it, it's the same thing. In one time, we used the fixed cost divided by units contribution margin. The other one was the fixed cost divided by the contribution margin ratio. Now let's see the effect of changes in fixed cost. So what if the fixed cost has changed? The break-even point is affected by changes in the fixed cost, unit variable cost, and the unit selling price. So fixed costs do not change in total with changes in the level of activity, but may change because of other factors such as changes in the advertising, property taxes, or supervisor salaries. Of course, we live in a world where things can change. Even we think they're fixed, maybe they're fixed for a certain time, but not all the time. So let's go back to an example here. Assume Bishop Company is evaluating a proposal to budget an additional $100,000 for advertising. The unit selling price, the current one, is $90. The proposed is still $90. The unit variable cost is $70, and the unit contribution margin is $20. The thing that they are proposing to change is the fixed cost, which is it's going to increase from $600,000 to $700,000. So Bishop's break-even point before the additional advertising expense of the $100,000 is calculated as follows. We look at the fixed cost, $600,000, which was given to us here, divided by the $20 contribution margin per unit, which is the difference between the 90 and the 70, and that would be 30,000 units. After the proposed additional advertising expense, we need to calculate the new break-even sales in units. So the fixed cost will go up to 700,000 instead of 600. Our unit contribution margin is the same, and that will give us 35,000 units. So in order to be able to break even based on the additional advertising expense, we have to increase our sales by 5,000 units, from 30 to 35. So based on that, we can conclude that if fixed cost goes up, then the break-even point would have to go up as well. And if the fixed cost goes down, then the break-even point would go down. So this just tells us that cost and break-even point, they go in the same direction. And here we're talking about fixed cost. What if there's a change in the unit of a variable cost? In unit variable cost, in other words. I think it's going to be the same. If the cost of the unit variable cost goes up, then we expect the break-even point to go up as well. But we'll prove it. So unit variable costs do not change with changes in the level of activity, but variable costs may be affected by changes in the cost per unit of direct materials, the wage rate of direct labor, or in the sales commission paid to salespeople. So let's assume this example. Assume part company is evaluating a proposal to pay an additional 2% commission on sales to its salespeople as an incentive to increase sales. Again, in this case, that's a variable cost. It's a sales commission. It's going to increase by 2%. So our current situation, we have a unit selling price of $250, which is going to stay the same. The variable cost is going to increase from $145 to $150. So the unit contribution margin used to be $105, now it's $100 per unit. The fixed cost is the same, $840. Okay? So how we got the 150 here, they're just explaining it. We had a $145, that was the original value, plus a 2% increase based on the selling price. So 2% multiplied by $250, that's $5, so you add it to the 145, so the new variable cost is 150 then. So Park's break-even point before the additional 2% commission is calculated as follows. We get the fixed cost, $840,000, which was given to us here. And then we divide it by the unit contribution margin, or as I like to call it, contribution margin per unit, which is 105, and that would be 8,000 units. After we make the 2% proposed increase in sales commission, the variable cost will go up from 140 to 150. So that would have an impact on the unit contribution margin by lowering it from 105 to 100. Because keep in mind, the unit contribution margin is the difference between the selling price and the unit variable cost. So when the unit variable cost went up, the unit contribution margin would go down. So look at the new break-even in sales per unit. The fixed cost is $840,000, or not per unit, I mean in units. The $840,000, that's the fixed cost divided by our new or proposed unit contribution margin of 100, that would make it 8,400 units. So now, in order to be able to break even, we have to increase our sales by 400 units, just to satisfy the 2% sales commission increase. So we assume that this increase in the sales commission should increase the unit sales by more than 400 units. So again, like the fixed cost, the same direction here. When the unit variable cost goes up, the break-even point will also go up. And when the unit variable cost goes down, the break-even point will also go down. Now let's see the effect of changes in unit selling price. So changes in the unit selling price affect the unit contribution margin and therefore the break-even point. But in this case, it would be working opposite direction. So let's see an example. Assume Graham Company is evaluating a proposal to increase the unit selling price of its product from $50 to $60. So now we're increasing our selling price from 50 to 60. The variable cost is the same, but the contribution margin will go up from 20 to 30. The fixed cost is still the same, it's not changing. So the break-even sales in number of units would be the fixed cost, which is 600,000, divided by the unit contribution margin of 20 based on the current situation, and that was 30,000 units. When we are going to increase the selling price, our contribution margin is going to go up. So let's do the math again. The fixed cost is still 600,000 divided by the revised unit contribution margin, or proposed unit contribution margin of 30, and that would give us 20,000 units. So our break-even sales now are less. In order to break even, based on an increase in selling price, we expect that the break-even point would go down, which is actually good news. So the relationship here is inverse. When the unit selling price goes up, the break-even point will go down, and vice versa. When the unit selling price goes down, the break-even point will go up. So this table just gives us like an easy way to remember this relationship. So fixed cost and the unit variable cost, they work the same direction with the break-even sales. The unit selling price and the break-even sales would be inverse. When this goes up, the other one will go down. Now let's talk about target profit. So what is target profit? We're talking about break-even. When break-even is when we are assuming zero profit. But let's say we want to have a desired profit. Can we calculate our sales in volume and maybe in dollar values? So by modifying the break-even equation, the sales required to earn a target or desired amount of profit may be computed as follows. We used to have fixed cost divided by units of a unit contribution margin. Instead of that, we have fixed cost plus a target profit divided by the unit contribution margin. We get the sales unit. So let's see this example for Waltham Company. We have a fixed cost of 200,000. We have a target profit of 100,000. The selling price is 75. The variable cost is 45, which means that we have a unit contribution margin of $30, which is the difference between these two values, the 75 and the 45. So the sales necessary for the company to earn the target profit of 100,000 would be calculated as follows. We get the fixed cost plus the target profit divided by unit contribution margin, which is the 200,000, that's the fixed cost, plus the desired or the target profit of 100,000 divided by the unit contribution margin of 30, and that would tell us that we have to make a sales of 10,000 units in order to have a profit of $100,000. Just to confirm it, let's try to prepare an income statement. We have the sales, 10,000 units at $75. Remember, that's the number we just calculated, the 10,000. That would give us $750,000. We subtract the variable cost, which is 10,000 by 45, that's $450. And the contribution margin would be $300,000, which is basically the difference between 75 and 45. That's the unit contribution margin multiplied by 10,000 units. We subtract the fixed cost of 200,000, we get the operating income or the desired operating income of 100,000. If we want to calculate the contribution margin ratio, we get the unit contribution margin divided by the unit selling price, and that's 30 divided by 75, and this would give us 40%. In terms of sales dollars, we get the fixed cost plus the target profit divided by the contribution margin ratio. We get the sales dollars to reach the desired profit of 100,000 would be 200 plus the 100 divided by 40%, and that would be 300,000 divided by 40%, which is equal to $750,000 in sales. So to make a profit, given the variable cost and the sales that we have and the fixed costs we have, to make a profit of $100,000, we need to make sales of $750,000 or $750,000. All right, now let's quickly try to test our knowledge. Kathy's confectionery has fixed cost of $78,000 and would like to earn a target profit of $90,000. Its product sells for $15 and has a unit variable cost of $12. How many units of the product must be sold to attain the target profit? So remember, we need to add the fixed cost to the desired profit, and then in this case it would be $168,000. And we also need to calculate our unit contribution margin, which is easy here. It's $15 minus the $12, the selling price minus the variable cost, which is equal to 3. So let's do the math here. So our fixed cost plus the target profit divided by the unit contribution margin. So 78 plus 90 all together divided by 3 would be equal to 56,000 units. So the right answer is A. Alright, so let me stop here. In the next video we'll start going over graphic approach to cost profit volume analysis.